Hello, everybody. We're here to talk about the big, beautiful bill. Here with Shauna Theriault, advisor here, CFP, CPA, all the things. Shauna, we have to do this.
Big, beautiful bill.
Every time we talk about the big, beautiful bill.
So funny.
Let's break this down into whether you agree with it or not.
Right.
It seems to be pretty beneficial to many taxpayers. So I'll let you kind of break down how it affects individual
taxes. Yeah.
And I'll talk about it more high level.
Right. Absolutely. So there's a lot of tax changes. I'm still digesting and looking, but we definitely wanted to bring you some updates on that. First of all, there's several provisions from the act previous, the TCJA 2017 Tax Cuts and Jobs Act, that were made permanent. So the income tax brackets we've been talking about that were going to go away at the end of this year, those were made permanent. So the highest tax bracket is going to stay at 37%. So I know many were talking about that sweet spot in between the 24 and the 22 and 24%. That's where the best break was previously, but this is all permanent now. So that's great. With that became the permanent of the estate and gift tax exemptions as well. Currently, it's $13.99 million. It is going up to $15 million permanently and being indexed for inflation starting next year. So that is a permanent change, as permanent is in the government. So there's new standard deduction amounts. This is proactive or retroactive to January 1st for the standard deductions this year. So it's increasing for single and joint, so up to $31,500 for joint filers. But then also the 65 and older, it's still going to have the senior deduction. The regular deduction for 65 and older. But now there's a new senior deduction as well. There is an income limitation to that, though. So the senior deduction is $6,000 per family, but it is phased out. So if your income married filing jointly is between $150 up to $250, it's completely phased out over $250. So there's an income limitation to that. There is, for the child tax credit, there's a permanent extension for the child tax credit that increased to $2,200 a child. It was at $2,000. So the maximum refundable credit is $1,700, but the child tax credit did go up, and that is now permanent. They have also permanently eliminated the miscellaneous itemized deductions that happened several years ago. So that's like your tax prep fees, investment management fees, and business expenses for salaried employees. That is permanently gone now as well. There was an extension or permanent now for the AGI for cash contributions to 501c3 and your charitable deductions. That used to be limited to 50% of your adjusted gross income. That is now permanent at 60%. So those are the things that were extended and made permanent. Other changes that the president made. So he talked about doing 4 different tax cuts: no tax on tips, overtime, then the senior deduction, and then the auto loan interest deduction as well. So that's interesting. So those were all put into place, but they expire in 2028. So that senior deduction I talked about, that does expire in 2028. That's $6,000. So there is no tax on tips. So that can be claimed. It's up to $25,000, but there's an income limitation on that as well of $150,000 for single, $300,000 for joint. No tax on overtime. So it's really, there's a limitation. It's deducted up to $12,500 or $25,000 for married filing jointly. So look at the provisions for that. There's also income limitations on that as well. The auto loan interest deductibility, which is interesting. I've never heard that before. This is the first time that I know of that we've had this. So you can write up to $10,000 a year on interest paid on qualifying auto loans. They have yet to, I guess there is a breakdown of qualifying. We're not going to get into the details, but up to $10,000, there is an income exclusion on that as well. So you'll want to look at that. But you can potentially deduct some of your purchases for cars, and that's cars purchased between 2025 and 2028. So there's a limitation.
I think
on
we
that.
should add to this though.
Yeah.
I would not go get an auto loan because you can deduct it on your tax return.
No,
because you're not going to, it's not dollar for dollar. So, right.
It's not a credit.
It's not a credit. Right. So it's like, would you rather have $5,000 and deducted on your taxes, right? At
whatever tax bracket.
Yeah, whatever tax bracket you're at. So let's say you're in the 24% tax bracket. At 24% of the $5,000 in interest that you pay, or would you rather just not have a payment?
Yeah.
It's better to not have the payment.
Exactly.
Right?
Yeah.
You're gonna pay more in interest than you are going to get deducted. So I guess if you have to have the payment, then I guess this is an added kind of goes back into your pocket thing, which is, I understand what he's trying to do. He's trying to help working people.
Right.
But please don't call us going, I want to buy a car because it's tax deductible.
No, absolutely.
As an individual, that's not a thing.
Our clients with the biggest, most resources, I would say, drive the cars longer, and they're not buying cars every couple of years.
Yes, I just
definitely
head that off right now.
Some of the deductions that change. So the state and local taxes, we have been limited to $10,000 a year for a deduction if you itemize for your state. That's like your real estate taxes, your state tax that you deduct on your tax return. So that will now go up to $40,000 a year. That's retroactive to January 1st. There is a limitation of that, an income limitation. So married filing jointly is 500,000, fully phased out at 600. So it was like, I was thinking about that. If you have really high state tax that you haven't been able to deduct, you might be over that income threshold anyway.
Correct.
But so it's really for, people under 500,000.
But if you own a business, this is not the business portion of our presentation here, but if you own a business, you maybe want the business to pay your tax, the state tax, meaning the business files its own state tax. You still have to pay your W-2 tax, obviously, but there's some ways that you can kind of work around that.
Absolutely. So that is a way that you may have a bigger tax break this year, which would be great. There is different limitations now on charitable deductions. So, I think maybe they use this to help offset some of the deduction increase for, the state and local taxes. So for charities starting next year, you're going to have a floor of 0.5% of your adjusted gross income. And so what does that mean? And so if you have, charitable deductions of X and you make a contribution, it's going to look at what is similar to like your medical expenses. It's going to say 0.5% of your adjusted gross income. It has to be above that, and whatever's above that, you can now deduct in your itemization. So that is a change there for charitable deductions. So obviously you can do up to 60% of your adjusted, but now there's a floor on the base that you have to deduct against that. There is also, if you don't itemize and you still make charitable contributions, they made permanent for $1,000 for single filers, it was $300, and $2,000 for joint filers, it was $600, that you can deduct for charitable expenses or charitable gifts that you make, and you don't have to itemize. So that was a change there too. And so if you are, giving some amount, the $1,000 for single or $2,000 for joint, you will be able to deduct that. And even if you don't itemize, so that's great as well. I did see that there may be some limitation on your total itemized deduction starting next year. If you are in the highest tax bracket of 37%, I did not get into all the details of that, but just know if you're in the highest tax bracket, you may be limited next year on your itemizations starting next year. The last thing, or one more thing, the AMT, alternative minimum tax, previously in 2017, they had increased that for $500,000 for single and $1 million for married filing jointly. They made that permanent as well. So it was set to sunset. So now if you're, if you're married filing jointly and then you're making less than $1 million, then you're not going to have alternative minimum tax or AMT. And the last thing is they created Trump accounts is what they're referring to them as. So for children born this year through the end of 2028, they're going to the government will contribute $1,000 to an account for every child born. It will be invested in some sort of index fund or index stock, U.S. stock index. And you can parents can contribute up to $5,000 per year until they're 18. It's roughly going to be kind of like an IRA. So you'll want to look at the details of that. But interestingly, your employer can also contribute $2,500 for your children, and it's not taxed to you. So more details on that coming out later, but thought that was interesting as well.
That is very interesting. If you actually filled $5,000 a year until they're 18.
Yeah.
that's a lot of money.
Yeah.
That so much time to compound. Let's bring it back high level just for a second. The CBO, so the Congressional Budget Office, estimates that the bill is going to add 2.4 to 3.8 trillion to our federal deficit over the next 10 years. There are some tax cuts costing 3.7 to 4.5 trillion, and spending cuts, which were mostly to Medicaid. Don't get that confused with Medicare. I've actually seen some politicians purposely trying to say Medicare was cut. Medicare was not cut. That's what you're on at 65 until you pass away. Medicaid is for people who are disadvantaged for whatever reason and have very low income. But there are cuts to that program to help fund all this. There are, the Trump administration's response to this was that the Congressional Budget Office was counting on the 2017 Tax Act to expire, and that therefore those numbers got put into the cost of this. They said they were looking at it wrong, and they actually think it'll lower the deficit. Congressional Budget Office is usually wrong, and politicians are usually wrong. So it's going to be very interesting to see how this plays out. Obviously, the bromance between Trump and Elon Musk kind of blew up over this whole bill, partially because Elon was brought onto the scene to help fix the deficit, which is, as investors, we are very concerned about over the next 20 years, what happens to our national debt. We could end up in 20 years at a point where 75% of our tax revenue has to go just pay our interest, which is why you're seeing the president really beat up the feds over lowering interest rates as we are refinancing trillions of dollars right now over this year, mostly from COVID, all the COVID stimulus. So I think it's a win for everyday people. I'm concerned about the fiscal policy of our nation long term, and if I could talk to the president, I would challenge him that he's probably the only person who can solve this as a one-term president. And we really need something put in place to be fiscally responsible as a nation. And so that really concerns me overall. But I think for everyday working people, if you have household income below 150, this is a win. And those are the families that were hit the hardest over the last 4 years with just crazy inflation. So hopefully this all works out, and we do have great economic growth through this. If we do, then that will certainly help balance a budget maybe at the end of the 4 years. We'll see. Thanks for watching. Obviously, all this is we're still learning about a lot of this, and the bill's very very deep. We didn't actually read the entire document, nor did any politician, I don't think. But as it relates to personal finance, we'll certainly be looking for ways to take advantage of what we can for the clients. Thanks for watching. Have a great day.